Three stocks I'm buying because of the coronavirus dip. We've got a lot to talk about, so let's get started. The first stock on this list is Carnival Cruise Line. I'm buying this stock because of its low value, high dividend yield, fast growth rates, and also the fact that it's a leading player in a growing industry. Let's start with low value. With a trailing P and forward P of 7, this puts it far lower than the sector median of 14. Along with this, CCL also has a price to sales ratio just higher than the sector median of 0.8 and a price to book ratio 54% lower than the sector median. At these valuations, I can't pass on the stock. We need to remember that the COVID-19 is a short-term cause for concern. Sure, earnings for the cruise company are definitely going to go down for the next few quarters, but give it a year and cruises will be up and running, and you're just looking at a phenomenal company on a seriously huge discount right now. A stock that was trading once at the $60 range is now over the counter for $33 a share. Warren Buffett once said, "Be fearful when others are greedy, and greedy only when others are fearful." When it comes to Carnival Cruise Line, we're looking at a company with massive hysteria surrounding the stock. And at this time of fear and uncertainty, we're looking at a great buying opportunity for Carnival Cruise Line. And now just another reason to buy the stock is its insanely high dividend yield. When the stock price goes down and the dividend payout stays the same, the dividend yield will increase. And this is what we're seeing right now with Carnival Cruise Line. The dividend yield increases as the stock price goes down. So you're probably wondering, will this dividend yield get cut? As the payout ratio is at 47%, and if the company is not making earnings in the short term, shouldn't the dividend yield get cut? The only time the dividend has gotten cut for Carnival Cruise Line was in the 2008 recession. Unless if we get into another recession, I can't see Carnival Cruise Line cutting their dividend, especially if their payout ratio is at 47%. And with the company having $20 billion of sales per year, usually growth rates are extremely slow for a company like Carnival Cruise Line. However, in 2021, their sales are actually expected to increase 7% year over year. And for stock that's trading at such low valuations, these are extremely fast growth rates. And finally, Carnival Cruise Line is the leading player in its industry. They control 45% of the cruise market, and this is an industry that continues to grow as time goes on. Through 2018 and 2020, we've seen a consistent revenue growth rate of 4% in this industry. The second stock I'm buying is Boeing. Boeing is a stock I'm buying because it's in a duopoly owned sector, it has extremely low value, and there's incredible demand for its new planes like the 777X, allowing Boeing to have very high growth rates for the future. The airplane manufacturing business is a duopoly owned business, and this is a good thing because it solidifies a moat for the business. In order to enter the airplane manufacturing business, you're going to need 1, lots of capital, and 2, lots of hard work to get past the FAA's regulation tests, along with plenty of other tests for other countries. And finally, even if you pass the first 2 steps, you still need to get airlines to buy a product, or else everything you've done will go to waste. My point is that this is a business that will likely forever be duopoly owned. Boeing also offers extremely low value with a 4P of 44 and a price to sales ratio of 2. And this low drop is primarily due to 1, a huge drop from the 737 MAX delays, and also the fact that the CV is going to lower earnings for airlines in the short term. This means that the airlines are going to have less money to pour into Boeing. And with all eyes on the 737 MAX, people are not looking at the 777X, which has been hugely successful for Boeing, as they had their first successful flight in the beginning of 2020, and keep in mind that this is going to be an expensive plane. Each of these planes will cost $410 million, by far the most expensive plane that Boeing has ever sold. These planes have extremely high demand, with already an $18.6 billion commitment from IAG to order 42 777X planes. After having a huge decline in sales, Boeing is expected to grow at massive rates in the future, with sales expected to grow 20% plus year over year in the next 2 years. Along with this, earnings is also expected to skyrocket, with earnings expected to grow from $4 a share to $16 a share in 2021. This is massive growth. And this just adds on to the fact that you're getting very low value for a company that has insanely high growth rates. And with that being said, let's move on to the third stock on this list, which is Tesla. Tesla stock has dropped massively because of the CV outbreak. And due to this, we're looking at much more reasonable prices for Tesla stock. In 2020, we're looking at massive Model Y ramp-ups, which will increase sales significantly, along with the everlasting long-term growth story of Tesla, with all these upcoming cars and tons of potential with Tesla's solar and battery segment that always seems to get overlooked. With Tesla stock dropping 27% since February 19th, Tesla stock now trades for $667 a share. And due to this, now we're looking at a price to sales ratio of 4.89, which is actually a lot more reasonable for a high growth company like Tesla. When we look at a company like Amazon, who's growing a lot slower than Tesla, their price to sales ratio is at 3 right now. Uber, who's losing loads of money every single quarter, has a price to sales ratio of 2.8, not too far from Tesla. When we look at a stock like Visa, Visa is a solid company, but it's not growing as fast as Tesla. It has a price to sales ratio of 17. And as far as the Model Y ramp up, Elon Musk has once said that the Model Y would sell more vehicles than Model S, Model 3, and Model X combined. And this is a reasonable estimate to make because the SUV market share is not only growing, it's also humongous. There's so much market share in the SUV market, and when Tesla approaches a market this big, we're going to see nothing but a massive vehicle delivery boom for Tesla in the next few quarters. And this is where the price to sales ratio is pretty reasonable. If Tesla's able to double their sales with the Model Y, along with the release of the Roadster and Semi, this would halve the price to sales ratio and make Tesla's price to sales ratio be around 2.4. And finally, with the release of the Cybertruck, Tesla's sales in the future are bound to increase significantly. Whatever Tesla produces is going to sell. The Tesla Cybertruck already has 522,000 pre-orders, and this doesn't even capture the whole market that would buy a Tesla Cybertruck. The Cybertruck design is genius. It will lower production costs and increase production capabilities. The Cybertruck ramp up will be quick and cheap, which is everything a car manufacturer wants. I can imagine gross margins going through the roof on this vehicle. And that concludes the video, 3 stocks I'm buying because of the stock market crash. If you enjoyed this video, please hit that like button and subscribe, and I hope to see you in another video.